All right, be the market expert and welcome to 2025, right? We are only a few days into this new market. And so not a whole lot has really gone on as far as, real estate in the real estate world, right? It almost feels, like back in our true seasonality days where real estate agents go to sleep as jack-o'-lanterns and they wake up as Easter bunnies. And I feel like that's what's going on for the real estate news. So we're not going to kick it off with any news articles. We're really just going to jump right into Housing Wire and lead analyst Logan Motoshami and kind of just see what he has going on. And so this is rear view facing data. So this is from Friday of last week. And he says, has the spring home buying season already begun? And our weekly pending contract data has shown year over year growth for some time now. Even with elevated mortgage rates, he believes that the spring demand actually started in November. And here's the thing, I think that there's absolutely some truth behind that. And with the seasonality of what we are seeing, I don't think it truly is around the holidays and around the schedules of life right now. It really is around the cost of money. And I think we have a lot of pent up demand. There is a lot of people that have waited on the sideline to purchase homes over the last few years. And they have been sitting on the sidelines, and there has been a lot of news outlets that have lied to them. There have been a lot of news outlets, whether it's Fox, CNN, YouTube, Twitter, insert wherever you get your news sources from. They've all told them about the housing bubble, the silver tsunami, the Airbnb bust, the mortgage rates coming down, right? The crash, the bubble, the insert whatever here. Like those have been the headlines that have been taking the brain space of our clients, and they're to the point where these motivated can no longer afford to hold out anymore. And we're seeing some very, very interesting things inside of our industry right now, right? Like we look around, there is inventory. Inventory is going up. Prices aren't really coming down. Yes, there are pockets of prices coming down in some areas. Homes are sitting a little bit longer, but yet home prices are not coming down. So if we look at this thing, we just talk about weekly pending inventory. Let's scroll all the way down to this visual. And it's kind of funny because we're looking at 2025. And so we're really all the way over here in this little blurb on the far left-hand side of this chart. And you can see this, and it says that we're actually starting the year with 260,000 homes in contract right now. So we got pending homes, 5% more single family homes in contract over last year. So that's a good sign, right? Like as we're looking at this thing, we want to keep climbing. We obviously want to see more homes on the market. We want to see more buyers and sellers under contract together. Like that's what we get paid to do, right? Like at the end of the day, that's what we get paid to do, put buyers and sellers together. And so when we're looking at this thing, we're coming up. So we're higher than 24. We're higher than 23. We're not higher than 2022. And 2022, again, that definitely a weird year, right? 2022, we started off with interest rates fairly low. And then towards the end of the year, interest rates started to go up very, very quickly. And we did see some things kind of teeter off a little bit. And so this is kind of where this is 2022. This is the beginning, and we can see it, right? Interest rates really started to rise, and we just started seeing things fall very, very quickly from here. But again, this is interesting because we still had very inexpensive cost of money, right? This is why this is so significantly higher, is because people were trading homes. And again, like we're not in that market anymore. We're not in a home trading market. We are in, I need this for my house because this is what's going to fit my family lifestyle, my needs. And that's how we have home buyers and home sellers more with the psychology of what they're doing now. Yet, when we look at the purchase application data, let's go just straight to the visualization of this. And what we don't really look at, and Logan talks about this as well, is like we don't put too much stock in this. Because yes, why I just said that seasonality wasn't a huge indicator, isn't as prevalent as it was, there's still seasonality, right? There are still psychologies of buyers and sellers out there. And so when we start looking at around the holidays, we do historically see it start to go down. And so we can actually see a pretty big decrease actually right here to where we are a little bit lower. And again, we're not going to put a whole lot of stock into that. We're actually just going to move on. We're not going to talk about the 10-year yield. We're not going to talk about the treasury. We're not going to talk about mortgage spreads. But let's talk about inventory, because inventory is important, right? When we have more inventory come on, we do know, historically speaking, that more sellers, they typically come buyers, right? Historically speaking, that's kind of how this thing works. Yes, there's going to be people that unfortunately they have passed away. They move into a senior, maybe assisted living center. Like some of those things could happen. And yet most cases, when someone sells a home, they're going to be buying a home. So we do want to see inventory. Now, if we look at this thing, we look at the inventory change from the 27th to the 3rd. We fell from 650,000 homes nationwide to 635,000 homes. So we did see a little bit of a decrease. If we were to look at year over year, we can look at this year over year data and we go from 513 down to 499. All right, so this was the same time last year, year over year data. And we can see this drop again. So again, this is kind of historically what we are seeing. We are seeing less houses hit the market, and again, it does look like the seasonality is alive and well. The all-time inventory bottom of 2022, 240,000. Again, we would see that more at the end of the year. And again, with kind of some of those things different happening, where we're going through and we're looking at interest rates, homes hitting the market, some different things. The inventory peak for 2024. So 2024 was last year at this point. Welcome again. We're back in 2025, 739,000 homes. So if we're looking at 739,000 homes, we do want to see this. We want to continue to see these numbers creeping up. But if for context, right, we like to look at pre-2019. Pre-2019, remember, 2020, we had a pandemic. 2021, money was free. 2022, money was free in the beginning of the year. Then it rose very, very quickly. 2020, what is it, 2023 now? We saw elevated. 2024, we stayed elevated. Now we're in 2025. We don't know what's going to happen with interest rates. They're probably going to remain pretty flat. They might go down a little bit. We might see something in Q3, Q4 of this year. And so when we're talking about more normal markets, we have to go 2019 or sooner as we're talking about these different areas. So we're talking about 1 million homes, 959,000 homes, active listings on the market this same week in 2015. Keep in mind, population was lower, prices were lower. And as we're going through, we have a bigger population. This is why we're seeing elevated prices still. Even with homes still sitting on the market longer, we're talking 90 days in most areas on average, and yet our prices are still staying elevated. So let's look at the national single family inventory. This is where we're starting. Here we are again, far left-hand side. We have 27% more inventory last week than we did this time last year. 27% more inventory. And so as we look at this thing, we are creeping up. Here's 2020, here's the pandemic, and here's 2019. Like, this is truly where we want to get. Guys, here's the thing. When we start getting back to one of these markets where it is more balanced, to where prices come down a little bit, like I don't think that I'm saying there's a crash. There's no world where that comes into play. Just think what has to happen for there to be a crash right now. But yet I do see prices could come down a little bit with more inventory coming onto the market, right? We also have to see more give, if you will, with interest rates. And we don't foresee that happening, especially with the jobs claims being where they're at. Like, I don't foresee that. So the only thing that's going to really drive prices on homes at this point is if more inventory comes on the market, because nothing's really driving interest rates down. So if we're looking at this thing, we do want to see it still creep up. This is good for both buyers and sellers, because again, yes, your sellers aren't going to be making as much money when they are selling their home, but again, historically speaking, they're also going to become buyers, which means that homes, when they're purchasing them, will also be less expensive as well. We're going through a little bit more in new listings data. Here we are. It looks like we're in the basement, right? But again, when we're looking at this thing, this is just the trend line for the year right now. And so we're all the way down to the bottom. And he kind of talks about it. Says he's very excited about the new listings data this year. Last year, he anticipated growth. And while we did see an increase, it didn't reach his target levels. So it's important to remember that most sellers are also buyers. We've talked that once or twice already. And the last 2 years presented the lowest listing data in our history. And he says this means that we can look forward to 2025 as a year where things return to normal. And we should expect to see some weeks where new listing data hit between 80,000 and 110,000 in peak seasons. And we know peak seasons, right? When we're talking about the spring market and we're going through and we're having these conversations. So this is why it's very, very important to start planting those seeds now, right? We're going through, we're having conversations with people on this snowy January day in Colorado. And we're going through and we're just making sure that we're getting back into relationship. Again, guys, there's been a lot of people that have been sitting on the sidelines and they've been waiting for the media to come to fruition about all the things that the media has been promising them. And it's not going to happen, right? And be thinking about that, right? And I know you guys have had this conversation before where someone says, oh yeah, I'm waiting for the market to crash. And it's like, cool. So you're waiting for the market to crash to do what? Well, for me to go out and purchase my first rental property or my first house. And you're like, awesome. So at what dollar amount do you actually think that the market's really going to crash to, right? To where they go through to where you're going to be able to go purchase a home in cash, right? Be thinking about that. Think about where our average price point is, right? Like depending on where you are in Colorado, we're anywhere from like $500,000 to $700,000 is our price point in our area for the most part. And so we're talking what, $100,000 crash, $200,000, $300,000. Like in what world do we think that any of that is a reality? And so we actually need to start having these conversations like, hey, buyer and seller, investor, seller, whatever. Where are you getting your information from? Firstly, like we need to be the real estate economists of choice, right? We need to be making sure that we're going through, we're looking at the data, that we can actually say like, hey, this is where we're actually seeing stuff. We can actually go to Housing Wire, we can look at Altos data, we can look at all these different things to be able to have this articulate conversation with somebody. But we also need to know where they're coming from. And we're not going to tell them that they're wrong, even though that they are, but they're getting their news from somewhere else. And I do think that there is a lot of people that are just worn out at this point. They are. They've been sitting, they've been waiting, and guess what? Prices haven't come down. Interest rates haven't come down, right? And so we need to be making sure that we know what our vendor partners have as far as what we can do to get them into a better rate. I think this year we need to get into better relationship with our new build execs, and we need to know exactly where their inventory is coming, where their new communities are going to be built for the rest of the year. Because they know, guys, here's the thing, like you can go into Horton, you can go into Century, you can go into insert whomever here, and they know where their new developments will be for the rest of the year. They've already bought the properties, right? Like they know, they're already developing it. They know when they're going to start. And so we need to reach out to them this year. We need to figure out, awesome, where are the new developments? What are we offering as incentives? Where are the old developments where you guys are looking to offload the rest of the remaining properties? And what can you do for my clients? What can you do for them if I were to bring you a client? And then what do? We need to get into our databases, right? Like we can throw it out on social media. We need to be sending out emails. Hey, I have the deal of the week, right? What are we doing with the deals of the week, right? Where we're going through, we got a new build. We know where we can actually get lower interest rates. Hey, I have, 4 properties that qualify for, 5%, right? Where we're talking about the rates. Like we can do all of these different things and we can push out this information. But again, this is one of the biggest things that we need to do this year is get back in a relationship with people because they've been on the sidelines and you become the hero knowing the better rates that we can get to them, the inventory that's sitting on the market to where we can get them at better prices than anybody else. You guys will win. So we're looking at this national, like we said, But here we go, price cut percentages. So already, I heard some the other day that on a call that said something like 70% of all homes took a price cut. And I don't know if that was accurate, especially as we're looking at Altos. But I think they were just really just talking about accumulatively like 70% of all homes that were on the market. But this is what this looks like. We know that 1/3 of all homes, annually speaking, take a price cut. We sitting in 2025, a week's worth of data, we're sitting at 35%. And so last year it did average out to 33%. So about 1/3, right? We're talking about 1/3 of all homes. And so as we're going through and we're pricing houses, these are also some of the conversations that we need to be having with our sellers, right? I think that this year we need to get very comfortable with being able to have a conversation with the people that invite us to the dining room table to talk about listing their home and set realistic expectations, right? Like as we're going through, what are some of the things that we need to be doing to help them get their home sold? And what we know is we don't want to be chasing the market downwards, right? 35%, 1 week's worth of data. Last year was 33%. The year prior was 36%. We need to be looking at all the homes in the area. We need to be able to have a conversation when someone's telling us about what they saw on Zillow or what their neighbor's home sold for back in 2021, or the fictitious number that they thought that they heard from one neighbor talking about another neighbor, right? Like we need to be comfortable having that conversation with them and letting them know the actual facts. So where are we going through? And so here we are. We can actually see these different numbers. We're not going to put a whole lot of stock into this number as well. 35%, let's just call it 33 for fun. Let's live off last year's average. 33%. We're still living in a 1/3 of all homes taking a price cut. So what are we looking at? This jobless claims. Guys, this is the reason why interest rates are staying elevated. People have jobs. And that's really what it is, right? And I truly mean that. Like we have a job loss recession fed. And when we were living in this inflation, this is why we can't drop rates because of inflation, and we're out of that, right? We're pretty much out of it. Yes, there's some things that are still pretty heavy, especially right now in Colorado, we got cage-free eggs. And those are expensive right now, if you can even find them. I know that Costco and Sam's Club were out there for a while, and yet we have this job loss fed. And so we have too many people with jobs. And unfortunately, that's what the issue is that we have a Fed that believes that people have jobs. And so being able to give money at a discounted rate would actually cause those people that are qualified to actually go out and spend it. And that's kind of where we are right now. So with people having jobs, what we're going to see is the Fed not cut rates. And it goes like this. He says, it's going to be an intense week ahead. We have jobs week, which includes all 4 jobs reports, plus the bond auctions, global PMI data, the release of the Fed minutes and speeches from some hawkish Fed presidents. Considering we have at a key level in the bond market, this week could get a little wild. As always, we'll watch for jobless claims data like we do every Thursday, and we will see what happens, right? So as we're kind of going through, this is where we're going to put all of our chips right now. If we come through and we see a good jobs report, we could actually see rates go up again. And that's just kind of where we are. So let's kind of look at mortgage. And so I did put it on 1 year, and here we are. Like, this is kind of what we want to see. If this could just live almost just flat like this, I know this feels elevated at, where are we? We're sitting at 6.8 for conforming loans, and we're sitting at 6.5 for FHA. But yet, guys, I think that a lot of the issues that we run into is more so when we live on these roller coasters, right? Like this is actually where we create more uncertainty for our buyers and for our sellers, right? When we start going through and they live and we got these big peaks and valleys, This is where we actually start to lose people. I actually believe that most people can wrap their heads around these elevated rates as long as the elevated rates were staying pretty flat, right? Like if they were staying pretty flat, most sellers and most buyers, I think, could wrap their head around this, right? Because here's the thing. And let's go through, and we know that things are taking about 90 days, right? We live in a market. We live in Colorado where things are sitting for about 90 days. We'll look at Altos data here soon. But let's look at this. So let's just say that 90 days ago, I, as a buyer or as a seller, were thinking about listing my home, knowing that homes are sitting on the market for 90 days. But yet, I know that I don't have enough cash in the bank to be able to go afford a house. I don't know about other lending products. I don't know about anything else. I just know that I need to sell my house before I can go buy a house. It's taken about 90 days. And so as we're going through and we're looking at all of these different things that are happening during this time, and look, rates are going up. And we do know that sellers become buyers. And so they need to sell their house. Well, when do they lock in their rate? Well, they lock in their rate when they go and they put an offer on a house, traditionally speaking, right? Historically speaking, that's what happens. They lock in their rate when they have an offer and acceptance on a home. Well, if it's taking 90 days, they're probably not going through and writing an offer. Yes, we're seeing contingencies being higher. Like we were just in the top producer mastermind on Friday, and these guys are seeing more conditional house, right? Where they're actually seeing more home sale contingencies on their offers that they are getting. So if a seller is selling their home and they're down here and they're thinking that now is a good time, but yet when they're able to actually lock it down, they're at 6.5 opposed to 6. This is the issue, right? Or let's say that they even lock in here, it's still 6.2. But here's the issue. We're looking through it, and with all this data that we've been living through, they actually do not know what the next 90 days is going to look like. This is very third world country, right? Like we live in the United States of America. We should be able to know what the cost of our money is going to look like and be able to forecast it out for 3 months, 6 months, shoot a year in all reality. And yet, as we're looking at this thing, 1 month, like this isn't too bad. Yes, it's going up, but it's not as roller coasty as this. So I think that as we're going through with elevated rates, I actually do believe that our buyers and our sellers are going to get comfortable with it as long as they stay pretty flat, because they know they can foresee in their heads kind of what 90 days is going to look like for them. Where if we kind of get back to one of these situations right here, this is what scares people off. If I sell my house, I won't be able to afford a home. Or the amount of money that it's going to cost me to buy a new home, I'm going to have a lesser of a home than I have today, depending on what interest rates do. This is actually, it's this market right here. This is actually what's stopping the buyers and the sellers. I don't think that it's truly the elevated prices. Yes, that's going to stop some people, right? But the majority of buyers and sellers, as they're going through, they've already made the decision to go out and buy the house. The uncertainty of what the market's going to do, I think, is what's playing a bigger impact on whether they actually pull the trigger. So let's dive into some Altos data. And guys, I think you should all get this report. You get one for free. They just changed their pricing, and so you do get one for free. Used to be able to get more than one, but obviously this is a for-profit company. And so as we're looking at this thing, I did pull Arvada 8 And so as we're looking at it, we can kind of see that we're staying pretty flat. Yes, it's going down a little bit, but at least in 8 our median price is $637,000. We're going through our price per square foot has been going up. Average days on market, 165 days. So this is 8 So this goes back to this. This is what I'm saying, guys. Like if we know that homes are sitting on the market and we don't know what tomorrow looks like or how quickly I'm going to be able to get an offer on my house, this is what's deterring people. And it's very evident right here. 165 days is the average, where the median is 144. So we're talking 21 days difference. We could round up a month and be generous if we want to be like, okay, cool. So a month difference, but yet the average days is what it tells me. We're going through, for those that don't know the what this looks like, but the average days on market, we're taking all the days on market, we're dividing them by the total of houses, average days on market. Median, we're taking out all the outliers, we're making our way into the middle, and we're figuring out what the middle days on market is. And so as we're looking at this thing, there isn't a whole big difference, but we're talking about 21 days. 21 days, 3 weeks. 3 weeks different if we price the home right. And what we already saw was that 1/3 of all homes are taking a price cut in last year, right? So last year, 1/3 of all homes, if I can find it, you think this would be an easier find for me right here. 33% of all homes took a price cut. Now, if we look at this thing, if we're pricing the home appropriately, we're also sitting on the market for less time. That's what this is showing me. So as we're sitting down with our sellers, we need to talk about where we're coming in at price, what the motivations are, right? Are we looking for the most amount of money, least amount of time? Do we need to be somewhere? Like, we need to be having these conversations with them, be that real estate economist, and just know that if we price the home right, we could be 3 weeks ahead of the competition, which is also almost a month less of payments and other things that are happening. Price decreases, here we go, 71%. 71. So we're actually above the national average for price decreases. Again, I can actually take this data to my listing appointment, talk about if we price the home right, we can actually be off the market 3 weeks quicker than the competition. And we know that 71% of all homes that are overpriced are taking a price decrease in this zip code. Price increases 7%. That number doesn't excite, right? Like 7%, what this number is telling me, phase 2, phase 3 of new construction, right? Like this is what this is. And so we're going through, we're seeing homes that are actually coming on and they have the house in the MLS, right? You can actually see the model home and the price increases are happening on that model home in the MLS. This is what this is. So this isn't an exciting number. This is not someone's going through and their house is falling off the market and then they're increasing the price, right? Like that's not this. Relisted, we're not seeing any data with that, but this will go up. Inventory ranking of 14. Your median rent, $2,600 is the median rent in our Nevada 8 2 right now, and a market action score of 48. So we still are in a seller's market. All right. We are in a better seller's market than we were last month. But again, like, we're not going to put a lot of weight behind that because we have been in the holiday season. Yet this is the time where we need to start having the conversations, getting back into relationships. So if you're not going to get into relationship or get into more conversations with your database, go out and find the vendor partners, right? Like, that's where we can be right now. We need to be talking to our people and figuring out what their 1 year, 3 year, 5 year goals are for real estate and how we can help. Or if they're needing a handyman or something, like, let us be that person. Let us go out and find them. Or we can be going out and figuring out where the deals are, right? Let's go get into relationship with the new builds, figure out what the lender incentives are, and let's make sure that we're getting that information out there to be able to take some massive mind share for the people that are in our ecosystems.